Ladies and gentlemen, SoFi stock is at a very weird moment of time where you have some analysts coming out and saying this is a $6 stock, with others actually coming out and saying that this is a $35 stock. So I wanted to cover my thoughts about if SoFi deserves a higher multiple, or better way to think about it, a higher stock price versus how much they're making. Now, is this just a bank stock? Well, this whole conversation comes down to risk assets, and there will be another piece, but we'll talk about that in a second. So, companies that have a lot of different loans, which would be considered risk assets that you're making a ton of money on, but you can potentially also lose them as well. They could be risky loans, right? Companies like Bank of America, JP Morgan, and Wells Fargo are full of them. And yet, whenever you look at those companies' valuations, it's priced very well into it, knowing that they have a lot of risk assets. So price to earnings relatively stay low, but most importantly, the actual book value for Bank of America, it's about 1.1 times, Citigroup 0.6, JP Morgan being the largest, probably the best bank in the entire world, at a 2 times multiple on their price to book. But that comes with many restrictions, like how fast you're able to grow, if you have to keep a certain amount in your balance sheet that is not allowed to be lent out, as well as the possibility of large default, which could potentially hurt your earnings growth going forward. Then you have fee-for-service fintechs like Visa, Adyen, PayPal, and one that I actually didn't put on this list, which was Amex. Amex is a bank, yet they actually demand a much higher premium, about a 6 times price to book, where you have companies like Visa and Adyen that have, 11 times or 17 times price to books because they're not really dealing in a lot of risk assets. Obviously, Amex does, but then they have a lot of other features of their business that potentially are fee for service, like credit card interchange, where they get a fee for doing that work without any level of risk on their end. Now, there is a portion of credit card debt which is risk, but that's why they're much lower than the potential Visas of the world that demand a higher premium. However, SoFi has a price to book of 2 times right now. And this is not tangible book, this is full book of 2 times. And their price to earnings ratio is roughly around 30 times. This is expecting to drop very quickly, as although this is, the current PE ratio that they have, GAAP numbers, their expectations for 2026 is somewhere around 68 cents, or more than double where we are today. So the, price to earnings would be also somewhere where we saw the banks as well. So is SoFi a bank, or are they a fintech? Well, to help explain this, we first have to look at SoFi's growth, which they're growing faster than almost every single bank in existence and looking more closely like a fintech whenever you just look at their amount of, expansion on margin and growth rates here. However, whenever you start looking at how they make money, mainly lending with, acceleration in their originations, which is the amount that they lend out, but then we need to look at the regulatory minimums. This is the problem with bank stocks, okay? And what holds them back from continuously growing faster and faster is that the government has come out and said, we need to be able to make sure that you can't lend out so much, okay? So they actually cap this at 10%, meaning they can almost lend out about 10 times more than what they actually have, but they can't lend out 100 times more. So although it sounds already very aggressive, the fact that SoFi has themselves at these percentages that are very close means that you can't keep extending yourself faster than what you can grow your own book at. So just going back, they are growing their book, but still there has to be some regulatory minimum for how much they can grow. Whenever we look at lending revenue, this used to be very fast. I mean, 50s, 40s percentages back whenever we were not a bank. And then as rates started to increase very dramatically after COVID, then those rates actually went into the negatives in Q1 of 2024 on a year-over-year basis in terms of revenue from lending. This is starting to reaccelerate up to 18.3% because the industry is looking a lot better. But if there is another bad macro environment, this could also drag revenues back into negative numbers. That does not get investors excited. Even though this is a massive total addressable market, you can see whether it's consumer revolving credit like credit cards or personal loans or home loans or student loans, the debt is in the trillions of dollars. And this is absolutely, massive for a company as small as SoFi to go after. But there's also a potential for them to underperform and lose revenue because they were lending out loans that were not being returned. Not even the principal was being returned, let alone the interest that they were sort of requiring to make in order to hit their goals. So this is where the balance between growth that has nothing to do with their risk assets continue to grow. So this lighter blue is actually their financial services and tech platform, or the way that you can think about it, fee for service. Okay, where the dark blue or the purplish numbers here are more along the lines of risk assets or potential for losses there. Now, a lot of that growth comes from SoFi's tech platform. This is going to other financial institutions and offering them a technological advantage for a fee for service. And we do that to the tune of helping out 168 million accounts get set up. Okay. It's an absolute massive business. The problem is that the growth rates here have kind of dropped off. So although at one point we were doing 85% year over year growths, now as of the last quarter, it was about 6% year over year. That doesn't get investors excited, right? And so if you're having this portion of your business that is fee for service not growing anymore, or not even close to growing as fast as lending, is SoFi going to return to more, risk-based assets, which places us closer to a bank? Well, this is where financial services in general comes in. So this is the SoFi Money, SoFi Invest, the regular banking accounts that you can have set up that have nothing to do with risk assets. If people want to put money into SoFi Money or spend using their credit card or potentially go and get an insurance product through one of our partner carriers, then that is completely fee for service, and SoFi makes money without having any limit to how fast they can end up growing. Now, I'm sure your eyes have gotten drawn over to this black circle that is top secret. It's going to be wiped away right now. So this is the loan platform business, okay? It's part of the member flywheel, which is very exciting too. Well, I'll try to explain that here in a second. But what you're noticing here is it's considered a financial services product, not a lending product, even though it has to do with loans. By the way, the technology platform is completely separated from this flywheel. So although we do see growth in the tech platform, it's still not as exciting as whenever we get it in that flywheel, because if someone comes for a SoFi Money product, they're likely to get some of these other products while they're here, including lending products, and that goes vice versa. So let's continue on. Whenever we look at SoFi's lending platform capabilities, there is all of this balance sheet growth that you end up seeing. That's personal loans, student loans, home loans, credit cards, perfectly fine. However, the loan platform business, which constitutes personal loans, falls out of financial services. And as it says here, these are loans that are originated on behalf of third parties that are actually originating loans through SoFi members. Okay, so they're going to SoFi members and saying, hey, do you want a loan? And that is all done through SoFi's platform. They never have to go to a different account. They don't need to go to someone else's financial institution. It all stays on SoFi, but the actual benefits of the loan, the payments of interest and principal back, end up going to that institution that originally originated the loan in the first place. So SoFi can sell loans, but it's 100% fee for service without taking any balance sheet risk. Okay. This is extremely important because although lending contributions are very, very high, I mean, lately they've been going around 60% in the last couple of quarters. Okay. Whenever we look at the other products that we have from SoFi, like the technology platform contribution, that rate is roughly cut in half, 31%. And it's growing slower. And yet this is the product that everyone looks at SoFi and says, this is why they deserve a premium. It doesn't quite line up. So yes, the technology platform is fee for service, which means there's no risk, there's no cap to growth. The actual, benefits of this product are about half of what lending is bringing in terms of the margin. But that's where you bring in financial services. Financial services has just surpassed the technology platform, bringing in roughly 44.8% margins in the last quarter, okay, looking extremely good. And by the way, we have not seen any plateau here. This is just only grown. So where are we actually going to see? Is this going to be better than lending? So the growth has been very dramatic. And by the way, all fee for service. This is where it gets interesting. SoFi is getting massive deals on the loan platform side. For the Fortress deal, which was a $2 billion one-year agreement, this is essentially split up between $500 million over, Q3 of 2024 to Q2 of 2025. Okay. Whenever we look at this, SoFi actually originated $1 billion in Q3 through the loan platform business, and Q4 brought in $1.1 billion. So the Fortress deal makes up for large percentages of that, but then the other deal percentages are slightly growing here as well. So Whenever we look at the total originations going back to SoFi on personal loans, yes, it is growing, but a large portion of that growth recently has actually come from the loan platform business on top of that. Okay. Now, contribution profit, another thing that I wanted to cover here is that the loan platform business is very much accelerating how much the margin is, which means it's completely accretive. We don't know how much the loan platform business is in terms of bringing in a margin, but it would be safe for me to assume that it was somewhere 50 plus in order to drag the entire segment much higher. So before the loan platform, we were at 31.4%. This has been accelerating over the last couple of quarters. So there'd be some natural growth in there without the loan platform. But a 10.5% jump here is way out of whack. I mean, even after the growth of the margin should start to plateau as we find some level of medium that SoFi should sit in. We have not seen that because they continue to put out products that are more margin accretive. And then even the quarter after that, they still went up to 44.8%. Now, financial services, unlike the tech platform at 6% year-over-year growth, or lending at 18% year-over-year growth, we were at 85% year-over-year growth. And the comps on that, meaning what was the year before like? Was it really down or something? No. We grew by 114% on top of the last quarter that they saw from the last year, 195%. So this company is increasingly accelerating how fast they're able to make more money in this business. And then the margin that they end up bringing in is no longer negative. We're seeing higher and higher positives here at better and better margins. So from Q4 of 2021, let's put this into perspective. They grew that quarter 441% year over year. To today, just a couple of years later, we're now at $256 million. Just from 2021, that is more, that's like a 12x on the business that they were doing. And yet we're still growing at 85% year over year. This is an unbelievable business. But wait, there's more. SoFi is continuing to close larger and larger deals with the loan platform business. So this deal was actually over a 2-year period. You can see how I sort of wrote this out. So from the quarter that they wrote it, Q1 of 2025 to Q4 of 2026, we're going to be bringing on an additional $625 million a quarter. That's on top of the existing businesses that we're already bringing in. So I showed you guys this part. This is what we're now going to see for the next 2 quarters. So we're going to see the Fortress deal come in at $500 million because it's for 4 quarters, right? So we're going to see this over the next 2 quarters. And then we're going to see Blue Owl come in with their $625 million each quarter. And then I assumed a very low 40% of the total originations is going to come from other deals, which places them at 1.875 billion originated in Q1 of 2025. And then in Q2, let's just assume a slightly higher other deal percentage, which places us closer to Q3 of 2024. That would land us at 2.25 billion. Okay. Imagine the other deal percentage continues to climb, goes to 55% or something like this. It would get even higher. But let's just assume, let's be conservative and say that this large deal actually brings this percentage down. This is somewhere where we should see it. So we know how much they're making on these deals. Okay. So on $1 billion that they brought in about $56 million in fee-based revenue. And then in Q4, they brought in around $63 million in fees. And then additionally generated $4 million in the actual servicing of those loans. So to a total of $67 million. So we know the take rate that they're bringing on. We know the servicing. And so the math is very simple. For the next 2 quarters, and by the way, this is each quarter, but this is at least going to happen for the next 2 quarters because that's the overlap between the Fortress deal and the Blue Owl deal, which, by the way, they're both allowed to re-up. So Fortress could then come back to us and say, hey, we loved what we just did last year. Let's do it again. But anyway, let's imagine they did 40%. At 1.875 billion, a take rate of 4.25%, we're bringing in nearly $80 million new dollars in Q1 of 2025. And then servicing fees on top of that at 7.5 million. So 87.1 million. And now let's assume that the other deal percentage is actually at 55%, which is, roughly what we saw last quarter. Well, then that would actually bring in, just in the next 2 quarters, 116 million new dollars each quarter. This is extremely aggressive, but this is the deals. Like, I'm not assuming anything here. This is the deal that both Fortress and Blue Owl have for at least the next 2 quarters. All right, so going back to this slide, the loan platform percentage of originations was roughly 20.44% in Q3. In Q4, that rose by roughly 0.5% just on the billion and $1.1 billion that we originated. Now, assuming going into Q1 and Q2 of 2025, my assumption is now that we're actually going to be bringing in roughly 31.1% loan platform business originations. And then in Q2, that could potentially raise to 34%. And by the way, all while SoFi's existing business that they want on their balance sheet as risk assets continues to grow, because the more fee-based revenue that they bring in goes to their balance sheet, which means that they have more risk assets that they could potentially, continue to lend out once again. So the underlying business of SoFi, the bank part, continues to grow, but what's funding it is completely cash-free, fee-for-service lending. And ladies and gentlemen, SoFi has recently said that they are now servicing their own student loans. So why does the loan platform business and loan servicing have to only deal in personal loans? It could potentially lead to SoFi student loans then getting the loan platform business treatment, meaning fee for service, no risk assets, all cash business. Now listen to this quote. It's a direct quote from Anthony Noto, the CEO of SoFi. One of the things that we contemplate is, could we push all of our lending into the loan platform business over time? And I'm not opposed to that at all. The economics are very attractive. The velocity is much higher. The capital is lower. You have a lighter balance sheet. It would really support higher return on equity. Okay? So remember, there's a massive total addressable market, but now it's completely up for grabs because SoFi is not restrained to their balance sheet anymore. That is not bank activity. So although people are very focused on Galileo, yes, it helps with R&D costs. It helps with better product speeds because we learn from our competitors and then we can put that into SoFi's own growth. There's more customer data, extremely attractive reoccurring revenue, low risk, everything like this. The loan platform also helps with a lot of those things. So although we're underwriting for other competitors, we're getting that for ourselves. We're seeing much better margins than Galileo. Ton of cross-sell because those people are still on the SoFi platform. It's not exactly reoccurring. We hope it's reoccurring, but Fortress and them have to re-sign up. We do see a lot of that in the industry, but it's not 100%. They don't have to come back, okay? Once again, extremely low risk revenue as well. So which one is the winner? Which one should get us the higher multiple? Well, it doesn't matter, okay? SoFi owns both of them. Okay, so they get the better R&D costs and the better underwriting, and it all goes back to one individual winner, which is SoFi. So if you ask me the question, does SoFi deserve a higher multiple? Yes, because its future growth is not determined by the size of their loan book, point blank. And the future growth is extremely high margin without any risk of losses. That does not put you in bank valuation territory. That puts you in the pocket of where Visa and Amex and all of those companies want to trade. But yes, I mean, we still do have some balance sheet risk. If what Anthony Noto says and they want to completely go that direction, then I mean, we deserve 100% of fintech multiple. But if we continue to have some level of a balance sheet risk, then I think that we should be priced somewhere closer to an Amex where we start to see price to book get placed somewhere around 6 times rather than 2. And that places us very close to where the analysts that place us at $35 a share would really want us. And so if you were to ask me, that's where I think that SoFi should be, not the $6 prices or even the prices of today around 12. I actually think we could probably triple from here. And there's still a compelling argument to say that SoFi is fair valued at those prices.